So when the interest rates started to decrease, people changed their strategy on what debt they would use. Some may argue it was a situation where people were just getting greedy and they were being very aggressive on thinking that the interest rates would continue to decrease. And because of that decrease, they didn't want to lock in on a fixed rate loan.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Welcome to the Bar Down Investing Show. I am your only host today. I'm Jay Scott. Kyle Wilson is off today, but we have the more important Wilson in the family here with us. We have Ashley Wilson, who is Kyle's wife. I guess Kyle is her husband, is the important part there. But Ashley is my business partner, our business partner at Bar Down Investments. And she's here to talk today about the state of multifamily and the future of multifamily. How's it going, Ashley?
Great. Thanks for finally having me on.
Well, you're the one that's been busy. We've been trying to have you on for a month or two now, and you've
Very
been
true.
pretty busy. So thank
Very
you for
true.
joining
I
us.
penciled you in.
Appreciate you making the time for us. Okay. You are the multifamily expert. So let's talk about multifamily today. I know that about a week ago, you were in Las Vegas for a conference called NMHC, and it's a big multifamily conference. Tell us a little bit about what NMHC is, what type of conference it is, who goes, and what type of information like you hope to glean from it each year.
So, National Multifamily Housing Conference is what NMHC stands for, and it is the number one industry conference that not only all investors go to, but all brokers go to, and a lot of service providers are there as well. Historically, there are around 10,000 people that are in attendance, but this year there were about 7,500. Last year there were about 6,000, and that is just because of the shift in COVID and what the dynamics of COVID has kind of changed the landscape of this conference. But it's a tremendous conference. It is packed with industry experts and also some non-industry experts. For example, Coach K from Duke basketball and the former U.S. Olympic coach. He was the keynote, and it was a phenomenal speech, a lot related to multifamily. In fact, I was feverishly taking notes while he was talking and then comparing notes with friends after his speech. But it's just an opportunity. The conference in totality is an opportunity for everyone to get together. And what it's historically known for is the rollout of different investment offerings. And the reason why the rollout happens at this conference is it coincides with family offices, private equity, and institutions roll out of their capital for the new calendar year. So it coincides nicely, and it makes the properties that come out during this conference to have really competitive bid process. During the conference, it also allows for opportunities to network with like-minded individuals and then also brokers. You don't always have an opportunity to network with all the brokers at the same time within a given market. So it allows an efficient use of your time to kind of just go meeting by meeting. In fact, that's what everyone does there. There are 15 to 30-minute time slots, and you're running around the hotel trying to find the next time slot, and you have back-to-back time slots, and everyone's late to the next meeting, and every meeting runs over. But it is just so exciting. And last but not least, every evening, there are about 4 or 5 different massive parties. So they're put on by different lending institutions, different brokerages, and they pull out all the stops. I mean, these parties, just one of them would be, the party of the year, and you get to go to 4 or 5 a night, which is pretty spectacular.
So I feel like you're making me feel jealous because I couldn't go this year. But that actually brings up a question. So I went last year. Like you said, fantastic, amazing conference, tremendous networking, some great deals are coming out of it. But when I went last year, obviously we were in a much different economic climate. Things were still hot, cap rates were still low, interest rates were low. We hadn't started seeing the interest rate hikes. Multifamily was just super hot last January, January 2022. Obviously, a lot changed in 2022. The climate changed, the economic climate changed, the lending and capital markets climate has changed. Did you feel anything different this year, just in terms of attitude or outlook, or just how did the conference feel just from the perspective of the whole economic climate being a little bit different this year than it was last year?
The most obvious glaring difference for me was that last year I would say 90% of the attendees were trying to sell a deal. And this year, 90% of the attendees were probably trying to find a deal and buy a deal, because of exactly what you said before. The debt markets were so favorable for buyers. I mean, you're basically getting the debt for free, especially if we look at it compared to today's cost of capital. But coinciding with that, you also have just a tremendous surge in the NOI, which came from rental appreciation, and the expense for properties was not moving at the same rate as the rents were. So you're getting that huge yield on NOI. So it was a great opportunistic time for sellers to sell and sell for major profits. So a lot of deals transacted last year, which then created a snowball effect of 1031. In fact, there was a lot of 1031 money carrying over from 2021 Q4 into 2022 Q1. So people were also justifying higher purchase prices because then they wouldn't have the exposure on the tax hit from that sale. So those things created kind of a perfect storm for people to sell, and there was just a fury of activity. I mean, I left NMHC last year not even being able to handle the properties that I got at NMHC, because it was just every broker had, 30 to 40 properties that fit our buy box, at Bar Down. But this year it was a lot different. I wouldn't say that there were no deals to be had, but the deals looked a lot different. I think if we look back at the spread between sellers' price expectation versus buyers' price expectation, there has been a compression there over the past 3 quarters. So I think we're probably at a 10 to 15% delta today than we were last year after NMHC, when interest rates started to hike, and it was, about 35% difference when those interest rates started rising. But there was just such a fury of activity at NMHC. But you can tell that there were a lot of hungry lenders. That is the biggest difference. And that coincides well with the fact that the lenders have to place this capital. They have to place the capital. If they aren't placing the capital, they're losing money. So they're very aggressively trying to find the people who are buying. Now, you and I just closed on a deal the week before NMHC. So the amount of lenders that were chasing after me that whole week I was there, I mean, they were stopping me in the hallways and they were like, "Ashley, we saw you just closed on a property. Why didn't you call us?" And it was just like, I couldn't get away from it, because, there are very few people buying today. And that makes it a feeding frenzy for the lenders trying to capture every single sale that's going on.
Yeah, and so I think you said a whole lot of stuff there that I want to unpack, but it basically boils down to the fact that we are talking, when we talk about real estate and especially multifamily and commercial these days, we're talking about two very different markets. We're talking about the properties that were purchased prior to the middle of 2022,
Mhm.
and then we're talking separately about everything that's happened after 2020, the middle of 2022, and basically where we are now. And so I kind of want to split the rest of this discussion into kind of those two things. Let's start with all the things that happened prior to the middle of 2022 and kind of where we are right now with the deals that were purchased in 2018, 19, 20, 21, beginning of 2022, and what should operators, like, where are operators right now in with respect to those deals? What should LPs, limited partners, passive investors in these deals, should they be concerned about what happened or what's happening now with those deals? You mentioned, let's start with, you mentioned that you're seeing since interest rates started to rise, a decrease in prices of, what is it, 15, 20%. What does that translate in terms of cap rates? How much have cap rates expanded since interest rates started to rise last year? What kind of pressure is that putting on operators who have deals that have been held since, I guess, a couple years ago? And what does that likely mean for limited partners in those deals over the next year or two?
Great question. I mean, you have so many questions in there, so I'll try to answer a few of them and then let me know if I forget some. But so when we look back at 2018, 2019, the interest rates were a lot more stable than they are even today. And when we look back at that time, there were a lot of different lending options in terms of debt options that you could place on your property. Obviously, you had the options of the government-backed fixed rate loans. You also had variable interest rates. And most often, people picked variable interest rates when they were doing heavy value adds with the idea that they would refi into a fixed rate loan after a value add was completed. On things that were more stabilized, everyone was just going straight to the government-backed loans, fixed rate loans. But then during 2019, 20, even 21, we saw a huge shift in the lending environment, and that is all due to the compression of the interest rate, which also compressed the cap rates. But let's just focus on the interest rates for now. So when the interest rates started to decrease, people changed their strategy on what debt they would use. Some may argue it was a situation where people were just getting greedy and they were being very aggressive on thinking that the interest rates would continue to decrease. And because of that decrease, they didn't want to lock in on a fixed rate loan. So even stabilized assets were now shifting from a fixed rate loan to a variable rate loan because just of the upside that people were looking at. They weren't really looking at the downside. And I don't think anyone could have predicted the interest rate swing we had. So in a normal environment, I think that exposure to an expansion on interest rates would have been okay if we had not had COVID. But what really happened is people went into these variable interest rate loans. They sometimes, but not often, locked into shorter rate caps. So that's obviously protecting them from the interest rate spreads. But what happened was not many people secured those interest rate caps for the term in which they were intending to hold the project. They just did it for shorter periods of time, a year, 2 years, 3 years. But that has now come to rear its ugly head today because obviously, if we look at the journey that people have had if they secured it in, let's say, 2019, 2020, 21, all of those rate caps are coming up, and the cost of purchasing a new rate cap is very high, and it's impacting a lot of properties' cash flow and their DSCR. Lenders are not in the business of owning property, and because there is such a huge amount of properties that fall under this situation, lenders are working out. I actually thought that there would be a lot of foreclosures taking place and properties selling on courtroom steps, and that doesn't seem to be the case. It seems that lenders are working out different new conditions of the loan that the person who is operating the property can work with to get the property back on track. Because they see this more as a short-term problem, which I think is probably good if you look at it, getting the inside scoop on what lenders are doing. They're not trying to go after taking over all of these properties. So that, I think, is a major shift in the history of multifamily. We haven't seen that over the tenure, at least not that I'm aware of, where there has been such a dramatic shift on what types of debt was placed on the property. And because of a certain type of debt being placed on the property and an extraordinary amount of properties that went under this debt, there is such a high exposure of those properties now being foreclosed on because of cash flow issues. So what does that mean from an LP perspective? It means that any LP that invested in a variable interest rate loan, you should start to have conversations, if you haven't already, with the operators to understand whether or not they're going to stop doing distributions to start with. Number two would be whether or not there's a capital call on the horizon, because obviously when you have a deficit of cash flow, you still need to pay all of your expenses and keep the lights on and keep people operating the property. So what does that look like? Does that entail a capital call? How many capital calls do they think that they might need to do, and the timing of those capital calls? Because as an LP, you have to participate in those capital calls unless your subscription documents say otherwise, which you should also consult your subscription documents too to see what happens in the case of a capital call. So those are some major changes that we've seen pre, 2022, mid-year 2022, like you were saying.
So just to summarize and tell me if this is kind of an accurate summary, basically for maybe good reasons, maybe bad reasons, doesn't matter. But a couple years ago, a lot of operators switched to floating rate debt instead of fixed rate debt, which is obviously causing pressure now as interest rates are going up. But in terms of the impact on limited partners, passive investors, it's kind of a mixed bag. So on the bad side, we're going to see likely lower distributions for deals that had floating rate debt. We may see capital calls, which for those who aren't familiar, capital calls basically the operator asking the investors to put in more money because they're having cash flow issues. But it also sounded like you said that there's not, at least at this point, a ton of catastrophic risk because lenders are still willing to negotiate and help operators who are in a tough spot kind of stay out of foreclosure. Is that kind of what I'm hearing at this point?
Yes. I mean, I'm not trying to say that there won't be deals, and there hasn't been a few deals that have been taken over by the bank, because I know of several deals that have been taken over. So it's not a blanket statement. So you're not, out of the woods just because I'm saying that the lender is trying to work with the operator. I think in part, it really depends on the confidence. I mean, I don't know this with 100% certainty, but if I was a lender, I would also look at the track record of that operator. So let's say, for example, it's an operator whose entire portfolio is underwater. That looks a lot different than an operator who has multiple properties and only one property is, maybe at a 1 DSCR or a 0.95 DSCR, right? So that is completely different. And if a lender has a track record with this particular operator and they know it's a matter of a tight rate cap issue right now, where they're just trying to get through the higher interest rates, I think that is a little bit different than someone who is just completely underwater. So I know as an LP, you might not have exposure to the other types of properties that operator has. It wouldn't be within the realm of reason to ask the operator, how are your other properties doing as well? I mean, the worst they could say is, they don't discuss other properties' performance, but maybe they will discuss, and that might give you a level of confidence that you need, or it might put you on alert that, all of the properties aren't doing well. But yes, that is an accurate summary of what is going on today.
So just for like completeness sake, let's talk about those other types of properties. So you talked about those operators who took on floating rate debt for, again, perhaps good reason back in 2019, 2021. But a lot of operators also got in with fixed rate debt for 5, 7, 10, 12 years. Are you seeing any risks or a lot of risks with operators who got in with fixed rate debt? What do those deals look like right now? Are those operators in a better position because they have fixed rate debt at low rates, or they still have risks that they should be concerned about and LPs should be concerned about as well?
In the short term, those types of deals are actually typically performing pretty well. The debt is stabilized, so it's able to be highly predictable in terms of operational financials. The only thing that you might want to be a little bit cautious on, because with everything there's always pros and cons. When you underwrite a property, part of what you underwrite is the exit cap rate. And the exit cap rate is dictated by the exit interest rate that a new buyer would be able to procure when they're purchasing the property. So the one thing to take into consideration is if that debt is not assumable. So even though you have good fixed rate debt, if the debt's assumable, then your property is most likely not, I won't say always, because we all know in multifamily there are no absolutes, but you're most likely in a situation where the property value could be very high and a good place to sell because someone can absorb the existing loan and therefore they could absorb the existing low interest rate. However, if that is not the situation where the debt can't be assumed, it might cause pause for exiting. And the reason for that is twofold. One is because the interest rate is pretty high. I actually just posted a question to everyone in LinkedIn that I'm connected with, which is, with today's underwriting, how do you perform out your exit cap? The traditional industry standard is 10 basis points for every year held. Well, if we look back even a year ago, we have a property in a market that we could arguably say was even sub four. We were around four, but the couple brokers we were talking to said that we might even be able to get like a 3.75 exit. And now everyone's pretty consistent in saying it's a 4.75 to 5 exit. Well, that's just in 1 year. So if you use the traditional underwriting methods on a 10 basis point hike on cap rate per year held, then you might be in a precarious situation to sell if you don't have debt that can be assumed. So I wouldn't say everyone is in this perfect situation if they have fixed debt, because there are situations like that where if they had fixed debt and they were planning to exit this year, they might need to hold a little bit longer, but they're probably in a situation where they're cash flowing and they can hold. It's just they're not going to get that yield maybe when they had originally projected. That would not only impact, obviously, their business plan in terms of just timeline for hold period, but it could also impact their total ROI via the IRR, because IRR is a metric based off of time held, as a factor that's considered in that calculation.
Makes sense. Okay, so that's a really good kind of overview of what LPs and even sponsors, how they should be thinking about deals that they purchased prior to all of this craziness starting last year. Let's talk about where we are now. I'm going to ask you to pull out your crystal ball and just talk to us a little bit about what we can expect. And this, both operators, people that are buying deals, but also LPs, passive investors in these deals, what can they expect in 2023, maybe even 2024? Let's start with the obvious question. Are there good deals out there right now? Yeah, let's just start with that. Are there good deals out there right now that you're seeing that other operators tend to be seeing?
Yes, there are good deals that are out there. There are people in very distressed situations that need to sell, want to sell. It's a matter of how long will it take for some of those individuals to realize that they have to take a loss. Some people are realizing that sooner than later. I know you and Kyle had Daniel Harvey on as one of your episodes, a guest on one of your episodes. And one of the things that he said to me that I live and die by now after he said it was, if you're going to lose, lose fast. And that is something that I don't think everyone buys into. Hopefully more people that, you and I are talking to, so that way we can capitalize on those situations. But there are always deals in every single market throughout the country and every single market cycle. So it's just a matter of trying to extrapolate those deals and find them.
So how are you underwriting differently? And this is kind of a loaded question because you and I are partners, and I sort of know the answer. But I'll let you say it. How are we underwriting differently? How are we thinking about cap rates? You talked about operators underwriting like future cap rates maybe differently than they were. How are you approaching deals differently today than you were a year or two ago?
That's actually the specific poll I posted yesterday on LinkedIn. So I gave three options. One was to use the traditional method on the 10 basis points hike per year held. Two is to assume that the cap rate will be the same as the current stabilized cap rate in that market. And third is to compress the cap rate. So the thing to remember with a cap rate, and oftentimes people forget this with a cap rate, I would say 90% of brokers that I talk to forget this about a cap rate, but they always ask me, well, what cap rate do you buy at? And honestly, if the deal makes sense, it doesn't matter what the cap rate is that we buy at, because we buy value adds, and cap rates are based off of stabilized assets. So in terms of when you're analyzing a property and you're performing out your exit, it's not necessarily the going in cap rate on that particular property. It's more so about the going in cap rate at that market for stabilized assets. So let's say, for example, that the market is at a 5 cap. What I pulled yesterday is, would you underwrite that at a 5.5 on exit? If it's a 5-year hold, assuming, would you underwrite it at a 5 exit, or would you underwrite it at a 4.75? And there's kind of different thinking between all of those answers. I think the first one is way too conservative, in my personal opinion, and I'll tell you why at the end. Cliffhanger. But the second one, I think that you underwrite a cap rate the same as it is today on exit is probably middle of the road. It might be a little bit aggressive, but I actually don't think it's aggressive. I actually think it's what I think we should be doing. I know you, Kyle, and I have had multiple discussions on this. And then the third is compressing it. And compressing it, I think, might be a little bit too aggressive for our personal taste, but I could see why one could argue that. So why do I think that using 10 basis points per every year held is too conservative? The reason being is our typical hold period is 3 to 5 years. The typical market cycle is 8 to 10 years. So if you look at where we're at today, we should land, should being the key word, not we will definitely land, but we should land at a middle of the road point in terms of our next market cycle. So nearing the end of the next market cycle, or even going into the following market cycle, but we should be on the upswing in terms of where we're at today. Today, I know that you have done several posts on recession, but I think we'll be coming out of recovery and we will be in the next market phase. So I actually think it's okay to write it that way, because I think interest rates will stabilize here shortly. Maybe it's just the opportunist, the optimistic person that I am, but I don't foresee interest rates continuing to skyrocket. I think that's kind of evident in the last interest rate hike. And I think we might have maybe ideally one more, maybe two more 0.25 hikes, but a quarter of point hikes. But overall, I think that we should be in a pretty stable condition. And then I foresee us coming down a little bit. And the reason I foresee us coming down, I actually talked to only one lender at all of NMHC said this, but I do agree with him, which is that he suspects that the interest rates are going to come down in Q4 of this year. Not everyone else was saying in Q1 or Q2 of 2024. And I think he has a really good point, which is cap rates and all the other metrics that the Fed uses to determine the interest rates are all historical data. They're always a look back. And I mean, we have to. That's part of, trying to guide the ship, so to speak, is to see where we're at. And where we're at is looking back. But because of the lag time, if you look at in terms of the transactions that have slowed down a bit, in terms of the interest rates that have slowed down, in terms of CPI, like if you look at all those variables to determine where we're going to be, I think that it's safe to say that we will see a slowing, pause, even a compression potentially. But ideally in 3 to 5 years, I think that is enough of a runway to say that there will be some sort of compression.
Yeah, I think that's a really good point. I mean, we're sitting here arguing, or not arguing, but debating over, are we going to see interest rates start to drop at the end of 2023 or the beginning of 2024? We could be off by 2 years. I mean, it could be 2025 or 2026 before we see interest rates start to drop. But like you said, most of the deals that we're buying in the commercial world, we're not going to be selling if we bought today until at least 2026. So even if we're off by an order of magnitude, even if we're off by a year or two, it's very likely that by the time we go to sell, we're going to be in that environment where interest rates are coming down, where hopefully cap rates are coming down, and things are looking more rosy than they are today. So that's a really good point. That's from the cap rate and the buying criteria side. But let's talk about another piece of the buy box that we're all focused on, which is location. So I know you and I have historically really liked a couple markets. Um, is that still the case? Are you still focused? Are we still focused on the same markets that we have been over the last few years? Are we switching markets? Are we adding markets? How are you thinking about market dynamics these days? And what metrics should operators and LPs be looking at to determine the right markets to be moving into over the next year or two or three?
One of my favorite meetings that we have is our market analysis meeting. And we do that every 6 months. And I think everyone that's in this business should be doing it at least every 6 months, especially now, because I feel like the environment is changing at such a rapid pace that we haven't seen pre-COVID, I'll say pre-COVID. So, what do I mean by saying that? I think there was a lot of migration due to COVID. A lot of people realized when they were sitting at home through one winter and then a second winter that they didn't like snow and they didn't want to be in the cold. If they're going to be at home, why not be in the sunshine? And we saw a lot of people move down to the Sunbelt region, and we saw a lot of people migrate into, the Carolinas and Georgia and Florida, especially. And then on the West Coast, we saw a lot of people, and Central, we saw a lot of people move into Austin and Boise. But how did that absorb, and how is it looking like today? So in terms of, the markets that everyone was talking about last year, Boise and Austin, we actually, I don't know if you've mentioned this before, but years ago, we called Boise. We said that Boise was going to be a very strong market. And we really liked it for a while, but we have put the brakes on Boise for quite a significant amount of time, this past year and a half, because we didn't like where it was changing. We liked where it was going to pre-COVID, and obviously we saw a boom. So I don't think we were wrong there on all the data we analyzed, but now it's looking different. So is Austin. So there are markets that we're still interested in that we really like, and then there are markets that we are not as heavy or interested. We've put complete brakes on Austin, complete brakes on Boise. Phoenix, I know we had looked into that a few years back. We were, a little, I would say, lukewarm about that, but now we're not even considering that market. So there are a few other markets that we've added because of the research and what it's shown us. But realistically, I think you have to constantly be looking at the markets because people aren't static. People move, businesses move, and just the way in which business can be conducted, policies change. One thing that we use as a guiding metric is whether or not it's a landlord-friendly state versus a tenant-friendly state. Well, one of the things to consider, and I've said this for a while, and a lot of people disagree with me on the timeline that I think it's going to happen, but I am saying it now that within 5 years, we will see a dramatic shift in the political landscape between the traditional southern states that we've seen. Why do I think that? Because the migration of folks coming from blue states into red states is extraordinary. And I think that we are going to see a dramatic shift in the political landscape because there's just this general rule of thumb in multifamily that blue states tend to be tenant friendly, red states tend to be landlord friendly. So what happens when you change the political landscape of the state? You change tenant laws and landlord laws, so it makes it either difficult or more easy to operate depending on what side of the coin you are on. That being said, that's something that we have to continually monitor because that impacts our day to day operations. It impacts our underwriting, it impacts our performance, and it impacts our cash flow. So there are a lot of variables that are impacted just because of political changes, not even on a federal level, right? So we're looking at it, locally, and that can have a dramatic impact on how we do business.
Yeah, and that's interesting because we often talk about longer hold times being safer simply because we have more time for these deals to kind of work out any kinks that they have. Maybe it's stabilization, maybe it's rent growth, maybe it's population growth. But it's interesting. You mentioned that the longer hold time here, you alluded to the fact that a longer hold time in some places could be a detriment if we see landlord tenant laws becoming more tenant friendly over that 5 or 10 or 15-year hold period. So just something else to be cognizant of. One more question before we end this, and this has been amazing. But for LPs out there who are still looking at deals, still interested in multifamily, you mentioned that there are going to be a lot of good deals coming up. I'm curious your thoughts on how returns are going to likely be impacted given the new economic climate over the next year or two. And so this is an interesting topic because I know yesterday we saw a very prominent syndicator in our industry that released a deal that we noticed literally didn't have any returns mentioned. There was no metrics around returns. There was a structure around returns, but there was no metrics. And this is somebody we all respect and a lot of us invest with. And so it was very interesting to see that shift. So talk to us a little bit about where you see returns headed over the next year or two. Are we going to see a drop in cash flow or an increase in cash flow, a drop in total IRR or profits or a decrease? Where do you see those going over the next year or two, given the market climate?
Well, first and foremost, the amount of variables that factor into this are extraordinary, right? So, from rudimentary variables like supply and demand, looking at how much multifamily housing options there are based on compared to single family and BTR communities, and just the way people are living. I had a whole conversation with someone, I think it was a week or two ago while I was away, about how baby boomers are not only opting to rent, but they're opting to live on cruise ships, which I thought was a incredible thought, something that I'm jealous of, because your housing's taken care of, your entertainment, your food, you get to travel, you're in great weather. So all of those different dynamics have a huge impact on the returns, right? It speaks to the supply and demand in the industry, it speaks to the business operations and those yields. I have said and thought for years that over time there would be compression in these alternative investing spaces that would mirror closer to the traditional stock market return. So the traditional and the historic average return in the stock market is 9%. So if we look at the delta between non-traditional investing, let's say, for example, multifamily, if you're looking at a core plus deal, you're looking at that 8 to 9 to 10% return. If you're looking at a medium value add, you're in the low to mid teens. High value add to new construction, you are in the upper teens, 20 to 30. And then as you look at different asset class, it's risk-based, risk-adjusted investments. I still think we will see a bit of a delta between the two because there's just an underlying assumption. I don't agree with it, but there's an underlying assumption that the stock market is a safer bet and safer investment than real estate. So I think we still will see that. I don't think it'll be an inverted relationship, even though personally I think it should be inverted because I think real estate is a safer bet. But that being said, I think that we will continue to see compression. I think that it'll mirror closely to the cost of debt. I've always looked at and found interesting that when you are a private money lender, your rates fluctuate with debt. And that to me was always a trigger and always, I just put a pin in that thinking that people aren't probably paying attention to that core fact, but that also parlays itself over to traditional investments like multifamily or single family or self storage, even, because really it comes down to where, and it is MC Laubschner who said this on a podcast that you and I did, which is, where does my money get treated best? And that's where money finds its home. So, because of that kind of thought process, I think that there's kind of like a seesaw effect going on right now between the multifamily industry and the debt markets, and people going back and forth and saying, for example, we opened up a pref fund at Bar Down, which I'm sure you've talked about, and it has a lower return than what we project on our traditional investments, but it's considered to be a safer return, and the capital is treated differently. So because of the risk, the less risk that you have, the less of a return. And I think that we're going to see more options like that come into this space. And I think people, at the end of the day, as operators, our ability to pay a certain price is entirely dictated on our cost of capital. So if we can lower our cost of capital, we get more competitive with our offers. We're able to then hopefully acquire more properties. And at the end of the day, that's what we're all in this business trying to compete against each other doing. And I think the debt markets are actually helping us get there, sometimes because of the way that debt fluctuates.
That's great. And that was, wow, that was a much more detailed answer
Sorry.
than I was expecting. No, not, that's a good thing, not a bad thing. Wow, so much to think about. And I could have this discussion for another couple hours. I think we're gonna have to have you back and deep dive into a few more areas that we didn't touch on. But from an overview perspective, where the market has been, where deals that are currently under in operations are headed, and what the risks are, and what the future looks like. This was all very eye-opening. Thank you for coming on. Thank you for offering these insights. For anybody out there that, I mean, hopefully we all know you, but for anybody out there that might not know you, might want to find out more about you, more about Bar Down, get in touch with you, check out your socials, how can people get in touch with you?
You can follow both Jay and I, bardowninvestments.com, and subscribe. Jay has an incredible newsletter. I'm sure he doesn't promote it, but it comes out every Tuesday, and I tell everyone about it because I personally read it every Tuesday. I think it's fantastic. It makes content that might be more complex on the original surface to be digested. And I really love that about your Tuesday newsletter. If you want to follow me on social, you can follow me at Badash Investor, which is BADASH Investor.
And absolutely do that. Ashley's social media content is absolutely amazing. It's not fluff. It's just, it's pure, unadulterated, multifamily gold, investing gold. So Ash, thank you so much for being here again.
My
We need to do
pleasure.
this more often. I'm not gonna let you avoid us for months at a time anymore. Um, so we will have you back soon, but thanks again. Appreciate everything.
Thank you so much for having me. And I'm definitely a better co-host or guest or however you want to capture it than Kyle.
There you go. Maybe we'll kick him out for a few
No,
episodes and
no,
let you come in and
he's
host for
so
me.
good. I'm just kidding. All
Talk to you soon. Thanks,
right,
Ash.
thanks.